Whatever you're ready.
We're ready to do the webinar for February 13th, 2018.
All right.
Oh, actually, it's April. I'm sorry.
Well, it's April 13th, but it's February production. No
February,
problem.
yes.
Yeah. And that's just, that's hard for people to understand, but we always have that 2-month production lag because companies, operators need a month to pull all their data together, and then they need a month to get it filed with us. So, so that's how that all works out. So welcome everyone. Thanks for those who are here in the room and everybody who logged on to the webinar. It's our monthly director's cut to talk about activity in North Dakota. I usually pick a theme. This theme, it's wait for it. If you take a look at the February numbers, production down just very, very slightly. 5,000 barrels a day, 0.4% on the oil production. So pretty much just held constant from January to February. Gas production, a different story. We set a new record. And so we continue to see the wells being brought on having higher gas oil ratios, and the core area producing more and more gas. So gas production was up 1.5% or 50 million a day. So significant increase and a new record in terms of natural gas production. We're still below the all-time high in terms of well count. We're about 11 wells below the all-time high. So that drop that we saw when winter set in, we haven't recovered from that yet. And that drop is really all in the conventional wells, the normal vertical wells that went offline when winter set in and we started to see the cold weather in late December. Permitting activities held pretty steady. 108 permits approved in March. So that's consistent with January, and February being a short month, 96. So it's very steady in terms of drilling permits being issued. Oil price is seeing moderate growth. We saw obviously a spike in prices early this week when the Syrian crisis cropped its head. And anytime there's trouble in the Middle East, you're going to see oil prices spike upwards. The other thing that tells us is that world storage levels are pretty much normal now. And we see that in the US storage study. You saw that last week there was a build, but we should have a build this time of year because we're less than 2 months away from the major driving season. So we should be seeing crude oil inventories build in the US right now. And so what we're seeing is normal. But the fact that a little concern about unrest in the Middle East spikes oil prices tells you that that big world surplus has worked itself off. And we're now in that situation where any significant interruption in crude oil production would mean shortages or a demand surplus imbalance. Rig count continues to slowly climb. We're at 60 today. Based on discussions with CEOs and operators, we could see another 7 to 10 rigs by the end of this year. And so that's moderate growth. That shouldn't stress the capacity of our folks out west too much, although there was a lot of news last week about housing and about jobs. And so if you've been following what they're saying in job service and what they're saying about housing in the West, you'll find out that there isn't a lot of slack. I think I saw that the apartments are at 80 to 90% occupancy levels, and that there are thousands of jobs open in Dickinson, Williston, and Watford City. So the demand is there for people to move to Western North Dakota. We're going to need to start talking about the recovery and the growth to attract that secondary investment in things like housing and restaurants and retail and all those things that make Western North Dakota a nice place to live these days. So, that really needs to be a message coming out of North Dakota. We saw the number of well completions drop pretty significantly. So we had 106 in December. We dropped to 57 in January and only 51 in February. And that's winter weather. If you look at the next paragraph I have down there, we had 16 days out of 28 days in February when it was -10 or colder. And so people do not like to heat frac water or pump frac water in that kind of weather. So it's understandable that we would see an increase, and we did. We saw the non-completed well count jump by 48, and the idle well count up 100. Again, we're still very hopeful that once we have warmer weather, once the frost laws and load restrictions come off, that we'll see those numbers drop, but they continue to build at least through the end of February, and nothing has changed really significantly at this point. So I would expect additional slow activity in March and an additional build, but hopefully April, May, June, we'll start to see that turn around and drop. When we look to the Fort Berthold Reservation, it's a little bit different story. Lost another drilling rig, so down one more. It was down 2 last month, down 13,000 barrels a day. So when you look at the balance, with the state statewide losing 5,000 barrels a day, the majority of that was on Fort Berthold, down 13,000 barrels a day, down 5 active wells, up 10 on the wells waiting on completion. So you can definitely see operators reacting to the need to do gas capture on Fort Berthold and some of the difficulties of dealing with a federal regulatory environment. So the picture there is not quite the same as the rest of the state. Moving to gas capture, big improvements, really nice to see, with 88% statewide, 89% in the Bakken, even the truss lands on Fort Berthold at 85%. So they made the goal this month, and the fee lands on Fort Berthold at 93%. So, but you can see what it takes if the infrastructure isn't there, or the infrastructure is lagging. What it takes to meet those gas capture goals is less production, less completions. That's just the way it works out. So the pressure is really on to move that midstream infrastructure forward. The Petroleum Council Gas Capture Task Force has essentially completed its work and has turned in its homework assignment. And so that's going to be discussed next week at the Industrial Commission meeting as to what, if any, tweaks they should make to the policy for enforcing Commission Order 24665. So I know that Justin played a significant role in helping those guys with data and analysis, and they've handed in some thoughts and ideas, and so we're processing those. And Tuesday, we plan to talk with the commission about revisions to that policy. Those are in process right now, and I've been out of town, and my assistant director's out of town today, so we won't get a chance to really talk about them until Monday, to really kind of get into any detail of what we're going to talk to the commission about on Tuesday. But I do anticipate that there's going to be changes to that policy, and so we'll encourage you to show up Tuesday and visit. The oil and gas portion of the Industrial Commission meeting is going to be held in the Coteau room, not in the normal place. There are 2 big items that need a room like that for vetting. One is the Missouri River Ordinary High Water Mark report. That is being delivered, and so the commission will see that for the first time on Tuesday at 11 a.m. and the gas capture plan. So a couple of pretty significant things on their agenda for Tuesday. Be watching for that. And the last thing I want to talk about is in the federal realm, there is one of the federal rules that continues to percolate, and so that's the venting and flaring, or the waste minimization rule, as they call it. First of all, comments. BLM has published their rule to rescind the vast majority of that rule, and those comments are due April 23rd. So the Industrial Commission will again talk about that on Tuesday. They've been reviewing my proposed comments, and so their staff are going over them, and so there'll be a copy of those comments put in front of them Tuesday to approve or modify and submit to BLM. And then the more recent development is that District Judge Skavdal in Wyoming granted a partial stay of the rule. And so he denied industry's motion for a preliminary injunction. He denied North Dakota and Texas's motion for a complete stay, but he stayed the parts of the rule that implement the, all the expensive, I should say, the investment requiring measures like changing out gas-operated valves and a lot of the repair requirements and that sort of thing. He granted a partial stay. Most of the rule is now stayed. The day after that, then 15 NGOs, and I don't have their names here, but if you wanted their names, we could provide them, filed an action in the 10th Circuit to appeal that stay. And that same afternoon, California and New Mexico filed an appeal. So again, there's a lot of ping pong going on with this rule. Maybe it's, yeah, I guess we'll call it ping pong. Judge Skavdal expressed a lot of frustration with this. He termed it administrative dysfunction. There are conflicting rulings between the Northern District of California and the Wyoming District Court, and there are multiple appeals going up to the 10th Circuit, and there is now disagreement amongst all the parties about what should be stayed and what shouldn't in preliminary injunctions. So Judge Skavdal is not very happy with the situation with the waste prevention rule. And it is extremely complicated, but I've done my best to lay it out in underlined text in the director's order. If you are a federal Department of Interior rule policy lover, you'll enjoy reading that. I think it now takes up a page and a half, maybe more. Now it actually takes up essentially 2 pages of the director's cut. If you want, we can trim that down, but I've always tried to keep the whole story there so that you don't have to look at multiple director's cuts to follow what has happened way in the past. And so the whole history is supposed to be presented there. So to sum it all up, oil production held very steady. That's very encouraging. So we're going to start this next growth cycle from a much better place than we expected. We thought we would be starting from below 1 million barrels a day. We're going to be starting from just below 1.2 million. And gas production continues to grow, even as oil production holds steady. So a lot of stress and strain on gas gathering and processing infrastructure. Winter is really what's holding everything up, and that can't last much longer. I hope I'm not jinxing anybody by saying that, but it just seems to drag on and on and on. Eventually, though, it is going to warm up, and the frost laws will come off, and activity is going to pick up. So good news, encouraging news for the near-term future for North Dakota's economy. And with that, I'll stop talking and take questions.
Anybody have any questions?
I do. Can you tell us, you said you're expecting some changes in the rule, and I'm assuming that's a flaring rule.
Yes, sir. Yeah.
What are you expecting, or can you share with us what you expect?
Yeah, so the question from here in the room for those on the webinar is I'm expecting some policy changes with regards to the gas capture rule, and what can I tell anybody, if anything. So what I can tell you is that industry has asked or has suggested that number one, we not remove the rule with regards to the reservation lands, that we keep everybody on a level playing field, and whether you're operating both on reservation and off reservation, or whether you're one or the other, that we keep everything level, and that we not do that. And so I don't anticipate the commission making that change. Industry has also recommended that we stick with the goals as they are today, that we not move those goals in terms of percentages or the timing. And so, you know, I anticipate that. Some of the changes that they're suggesting are a lot more technical. One of them that we're really seriously looking at is something called stranded gas, actually coming up with a definition for that. And let me expound on that a little bit. What has taken place is that some smaller companies, some larger too, but mostly smaller companies, have purchased assets that lie outside the core area. And some of those are now economic. They're above break-even oil price, but the gas gathering infrastructure out there is based on very few wells. And what wells it's based on were drilled 3, 4, 5 years ago, not using modern completions. It creates a situation where if a company were to go out there and drill one well, they would overwhelm the gas gathering capacity. So they're asking for some time to be able to develop, say, a full well pad or a handful of wells to prove up the economics of the area, and get some relief from the danger of production restrictions. Not necessarily from gas gathering goals, but that they could do that and not end up with those wells having production restrictions imposed upon them, because they're in a stranded area, a place, say, that like a township where there hadn't been a well drilled in 3 years, something like that. And then, let's see, a couple of other items were that we found out that the gas capture plans that we're requiring at spacing hearings are really a non-useful exercise. They take up a lot of time to be evaluated and to be prepared, and the information precedes the completion of the wells by so many years that it isn't really of any value. And so we're looking at some change to that process, not necessarily eliminating gas capture plans, but doing it at a different point in the timing of the well, and also frequent meetings with operators who are not meeting the gas capture goals. So we've been meeting on a semi-annual basis with gas gatherers. One of the things that might come out of this would be semi-annual meetings with operators who aren't meeting the goals. So a little, not huge changes, but some, I think, significant improvements in the process. I mean, the last time this was looked at was October of 2015. So we've got quite a bit more experience in terms of how this ought to work. And so we're looking at improving the efficiency.
To follow up, then there would be more tweaks than any major policy shift.
Yeah, so the question was, would we characterize it more as tweaks than a policy shift? And I think that's a good characterization, is that the policy needs to be tweaked in several areas to improve its efficiency and to target what really needs to be targeted, but nobody's looking for a major shift.
So one more, I don't mean to monopolize it. So the fourth quarter 2018 is still 88% capture, 12% clear.
It is right now, and the intention, industry has not asked to change that. They're recommending that stay the same, and I think I'm going to recommend that as well. That fourth quarter of 2018, it should jump to 88% capture. we definitely want to hold their feet to the fire, to make the investments and to manage their business so that we keep increasing that capture percentage.
Do you have the volume of natural gas that was flared in February?
Yes, I do. Thank you. So the volume flared in February was 255.7, or call it 256 million a day. I think that's interesting if you were to compare that to the announced gas plants. That's essentially 2.5 gas plants, or more than the big Hess Targa gas plant. So it does tell you why you're seeing 5 gas plants being constructed over the next year and a half, because there's enough volume there to fill them. Yep, 256 million a day. All right.
I got a question here. Bakken differential to WTI has been improving. Do you expect the gap to continue to narrow? And if so, what factors could push it one way or the other?
I'm going to please hold on to that question and ask Justin. He's got some really nice slides on that. But so if you guys can mark that and remember it. In the near term, we think that we're going to hang on to the improvements, but our projections based on rig count growth and completing these 900 non-completed wells is that we'll be exceeding the Dakota access capacity in 2 years or less. And what that means, unless another project comes along, is that those price differentials will start to grow again. And that of course will be a damper on increased activity. So Justin can give the hard numbers. Differentials have held very nicely, but that's going to be limited by the capacity of Dakota access.
Any more questions?
Do you anticipate at this point, with the flare, going back to the flaring policy, do you anticipate changing the consequences for a company that isn't meeting the goal?
Yeah, I think so. Let me first restate the question and make sure I understand it. Do we anticipate changing the consequences for companies that are not meeting the goal? So yes, in one respect, and no in another respect. Industry suggested in their meetings, and I think we're going to stick with it, that we retain the authority under the order to restrict production to 200 barrels a day or to 100 barrels a day, that we hang on to that, because that's what gives the policy its teeth. What we do anticipate is for some areas like this stranded gas, not a change so that we don't enforce those production restrictions, say in a stranded gas area. And then the other thing is a requirement that if you're not meeting the goals, you have to produce a gas capture improvement plan and meet with the commission and show us what that looks like. So actually, I guess we're not looking at changing the levels of potential production restrictions, but we're looking at tweaking that again, in that if you're not meeting the goals, you're going to have to come up with an improvement plan to show how you're going to get there. So that's an increase in enforcement. And then on the other side, some of these areas where there is truly stranded gas, allowing some relief there to where the production restrictions wouldn't be imposed. So it would be another level of here's an exemption to wells being restricted because it's a new pad out in a stranded gas area, something like that. So yeah, there's give and take being anticipated here, which I think makes sense. We're going to try to ramp up the enforcement and the consequences in the areas where there is infrastructure and infrastructure being built, and relax them a little bit where we need to incentivize infrastructure.
Are there situations where it's acceptable to have 0% gas capture?
There are right now, for example, if a well is so old that it doesn't produce 100 barrels a day and is out there by itself with no gas capture infrastructure, there are situations where you could have an operator with 1 or 2 wells capturing 0. So yeah, that does happen. And so now again, what's going to happen to an operator like that is their production is not going to get restricted, but they're going to have to come meet with my staff twice a year and put a gas capture improvement plan in front of them that can be reviewed as to how are we going to get from this place to where we're capturing 88%. So I think that makes a great deal of sense. That okay, you're not going to see immediate consequences for that 0 capture, but it's going to put you in a category where you have to come present an improvement plan.
All right, if we don't have any more questions, we'll move on to Justin.
You already got a question.
I've already got a question.
They didn't say that, did they?
No.
That's okay. That's why we do this together.
That's right.
Just wait for this to queue up for a second. We'll get the slides queued up online for folks. Okay, well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. We'll get right into some of the typical information included in this update each month. The final numbers are starting to roll in from the neighboring states for the Williston Basin for crude oil at the end of 2017. So we're looking at about 1.24, 1.235 million barrels per day total system-wide for the end of 2017. As we start moving into 2018, again, only 1 rig operated in eastern Montana, 0 rigs operated in South Dakota, so I do not anticipate any type of production growth from those areas anytime soon. I think it's going to take a significantly higher shift up in oil prices and a little bit more interest in those neighboring locations before we start to see any type of trend otherwise. The month-to-month shifts in production, as Lynn alluded to, we're now 3 months in a row of decreasing oil production that you see in the top portion of this graphic. Everything I'm kind of seeing, hearing, and noticing out in the oil fields is that, again, would agree with what Lynn was stating about as we move into March, April. Things appear to be improving. Again, the big unknown is how winter exits the region and what type of troubles that may bring with it. When we look at transportation and dynamics out of the region for the month of February, again, some shifts going on as far as how those barrels are being moved. Again, primarily the crude moving on the pipeline network is continuing to dominate the sector. We did see a slight increase in the amount of crude by rail leaving the region, and we'll touch on some of the pricing dynamics and what's going on in the markets that may be leading some of those barrels that aren't committed to a pipeline system back onto the rail network. When we look at how this has changed, again, that purple line trending in the last couple months upwards, again, that's the market share of crude by rail in purple, and then the blue segment of this, which has been fairly steady but down the last couple months, is the market share of crude moving by pipeline out of the region. Again, we'll touch on some of the market dynamics here in just a moment. When we look at barrels of crude by rail, my estimates are right around that 200,000 barrels per day. Again, trending upwards. The lower part, since Dakota Access went into service in 17, at one point in time, we were just over 100,000 barrels per day. Again, that was a lower oil price environment, lower production numbers at that time. As the markets have shifted, as production's increased, we're starting to again see those barrels that have that optionality move on to some of the rail market options. The destination continues to be consistent with the West Coast or PAD 5 region continuing to dominate the crude by rail out of North Dakota. Again, primarily the refineries up in the Pacific Northwest, Washington State. And then some barrels continue to move to the East Coast refiners and just very few barrels continuing to make it down all the way to the Gulf Coast or the PAD 3 markets. When we look at pricing, this was what refiners were paying in the month of January. So this is the most recent data set that we have available. If you look around the coastal regions, again, some shifting going on where PAD 5, the West Coast, was the highest priced region for crude oil acquisition prices in the country. $1.50 or so higher than even the East Coast, and a couple bucks higher than what was going on down in the Gulf Coast. And so it shouldn't surprise anyone that, again, with some of these higher priced markets that are only, again, the only way to get there is with a rail car. It shouldn't surprise us to see when those markets are higher priced for some of those barrels to have the flexibility, move out of the region by rail car, trying to reach those coastal refineries. When we look at what the markets are doing as of this morning, again, the Brent WTI spread just over $5, so that has been creeping upwards again over the last month or two. And then the LLS pricing down in the Gulf, which again, I've been using that as a good indicator for a Bakken-like quality barrel down on the Gulf Coast that has some transparency to it. $3 above what's happening in Cushing, Oklahoma, or that WTI pricing. Crude imports, exports through Canada. This is something that we've been watching closely the last several months. Was down both for imports and exports, and so it's consistent both directions. Again, still relatively high compared to what we've seen over the last several years, but this is a market dynamic that's very difficult to try and get any type of analysis on, or any type of insight of why, what quality crude is moving north and south, where those destinations are, because again, very limited data and not a lot of transparency from the market about exactly what those intentions are. When we look at flaring, now shifting gears, you'll notice that, as Lynn alluded to, some encouraging news on the gas capture portion for North Dakota. That blue piece of the pie, that is the smallest it's ever been, 1% of the gas being flared from wells that we call unconnected or zero sales wells. And the primary challenge going forward is going to continue to be that orange piece, those wells that do have gas capture connections. They just simply don't have enough capacity on those networks to move all of that gas to the plant and then to the marketplace. And then just a little historical look, again, that blue piece of the pie. Back in 2015, about 5% of the gas was being flared because of zero sales wells, and now we're down at 1%, which again is encouraging. And it just shifts the challenges, though, from just getting a well connection now to wells are getting connected much faster than they have in the past. Now it's optimizing and expanding those networks out in the field. And then just another quick market check as far as what the gas gathering industry is doing. They, again, in February, we're keeping pace with production activity. No big shifts there or anything alarming. And then when we look at gas plant capacity, you'll notice my forecast, what I call case 1 in red and case 2 in black. This is an updated forecast. This is the first look that anyone's had of the updated forecast numbers. I'll have all the details next week at the Industrial Commission hearing. But we do expect that over the next several months, gas production to exceed processing plant capacity. So again, not only having the connections and having the capacity of the network, bringing gas to the plants, at least in the near term until the end of 2018, when some of those plants expansions come online. It's going to be increasingly challenging for the industry to make sure that the plant they're connected to has adequate capacity to handle all the gas that's being delivered to it. So that is something that we'll all be watching very closely, particularly moving up into the more active months of 2018. And so with that, I'd be glad to answer any questions. It sounds like there was one earlier about WTI pricing, if I remember correctly.
Yeah, it says Bakken differential to WTI has been improving. Do you expect the gap to continue to narrow? What factors could push it one way or the other?
Okay. So regarding North Dakota differentials, WTI, what's happening in the marketplace, The most recent numbers I have from the tax department were for February, and that actually we were showing through the winter months, the December, January, February, a widening differential. So in February is about $5 per barrel discount between North Dakota and WTI. I know that just kind of watching the markets here in the last month or so, things have been improving. There's just a lot of things that occur with the Brent WTI spread, what's happening with inventories and Cushing, what's happening at the Gulf Coast, the refineries. So I don't put out any type of forecasts for North Dakota's discount going forward. I think the best we can do right now is look backwards and try to understand it. But again, the latest official numbers that we have are a North Dakota WTI discount of $5 for the month of February. Just for historical reference, in 2016, that yearly average was $7.71 discount for North Dakota. So again, things have improved relative to 2016, and we were expecting some ebbs and flows, obviously, with the marketplace, and I was going to give it 6 to 12 months before we kind of settle into what may be a new normal for North Dakota. So I'm not surprised to see the fluctuations, and again, I apologize for whoever asked the question. I don't have any type of outlook going forward for them.
We got a follow-up question to that. In your opinion, what's the bigger threat to long-term production, the lack of gas midstream capacity or the shortage of crude pipelines?
I think in the near term, I don't anticipate that crude takeaway is any type of constraint for the industry. We have seen the capabilities of crude by rail out of the region and their loading and ability to facilitate those movements. So I do expect in 2019 for production to exceed pipeline capacity again. But even in today's environment, we do have adequate pipeline capacity, and we're still having elective volumes of crude oil moving by rail car out of the region. So there are folks that are using the market to make those decisions of whether or not they put that barrel on a rail car, whether they put it in a pipeline system. But I don't anticipate crude takeaway to be a constraint. The first part about gas capture, I think those individual producers that are challenged with infrastructure or gas capture requirements, they're going to have to make those decisions of how they produce their well, what their drilling completion schedules look like, where they allocate their capital, not only in North Dakota, but U.S. wide. So I think in the near term, that's a more real challenge for North Dakota is operators continuing to meet those gas captures.
If all 5 current pending projects or projects that are being built for gas capture or for gas production, if they all went online tomorrow, would that basically get us back to where we're producing at capacity or maybe have a little excess capacity? And if that would happen, when do you think that that's going to go back to excess above capacity?
Yep. So the question was about
kind of crazy way to get there, but
about processing plant capacity and its impact on the overall gas capture. And so if you look at slide 15 of my PowerPoint, you'll notice that starting in late 2018, we expect plant capacity again to exceed production. Again, plant capacity is just one segment of that gas capture. So you have to have all 3 major components in place. You have to have the gas connections, the gathering capacity, and then you get to the processing plant capacity, and then we start looking at transmission capabilities out of the region. In the near term, the most pressing issues are still out in the field, the actual gathering pipelines. Then we're starting to look at the plants and making sure that the gas molecules can get where they need to be. And then longer term challenge for the region is going to be on the gas transmission side. So we're starting to look 5-10 years out and what type of transmission needs this region is going to need. So I don't know if that answers your question.
Have you heard anything recently on the Dakota Access open season? Any updates on whether they're going to expand?
I have not. And so, so the question was about any updates. Dakota Access did go out for a binding open season for additional capacity on that system. There was no public information out about what type of capacity, what type of terms surrounding that, and I have not heard anything other than what was publicly made available back when that was announced.
Yeah, looks like.
Okay, well, thank you very much.
Thank you.